Risky borrowing is making a comeback, but banks are on the sideline. New and untested players, some backed by Wall Street, have helped borrowers pile up billions in loans. What could go wrong? A decade after reckless home lending nearly destroyed the financial system, the business of making risky loans is back. This time the money is bypassing the traditional, and heavily regulated, banking system and flowing through a growing network of businesses that stepped in to provide loans to parts of the economy that banks abandoned after 2008. It's called shadow banking, and it is a key source of the credit that drives the American economy. With almost $1 in certain areas including mortgages, auto lending and some business loans, shadow banks have eclipsed traditional banks, which have spent much of the last decade pulling back on lending in the face of stricter regulatory standards aimed at keeping them out of trouble. But new problems arise when the industry depends on lenders that compete aggressively, operate with less of a cushion against losses and have fewer regulations to keep them from taking on too much risk. Recently, we decided to regulate the banks, hoping for a more stable financial system, which doesn't take as many risks, said Amit Seru, a professor of finance at the Stanford Graduate School of Business. Where the banks reach safe as houses. With roughly 50 million residential properties, and $10 trillion in amassed debt, the American mortgage market is the largest source of consumer lending on earth. Lately, that lending is coming from companies like Quicken Loans, Loan Depot, and Caliber Home Loans. Between 2000, is this a good thing? If you're trying to, they also have invested in some sophisticated technology. Just ask Andrew. I am not even exaggerating, he said. I think they called. Quicken eventually offered him a rate of 3.875% with 15% down on a conventional 30-year fixed-rate mortgage of roughly $185,000. Eventually, I really didn't reach out to any banks, said Mr. Downey, who expects to close on his condo in Union, NJ, this month. The downside of all this? Because these entities, if they don't have enough, it makes them less able to survive a significant slide in the economy and the housing market. While they don't have a nationwide regulator that ensures safety and soundness like banks do, the non-banks say that they are monitored by a range of government entities, from the Consumer Financial Protection Bureau to state regulators. They also follow guidelines from the government-sponsored entities that are intended to support homeownership, like Fannie Mae and Freddie Mac, which buy their loans. Our mission, I think, is to lend to people properly and responsibly, following the guidelines established by the particular agency that we're selling mortgages to, said Jay Farner, chief executive of Quicken Loans. Risky business loans. It's not just mortgages. Wall Street has this time, the assembly line is pumping out something called. These are essentially related video why hedge funds are resurrecting the CDO trade provided by Bloomberg. If that sounds somewhat familiar, it might be because a similar system of securitization of subprime mortgages went haywire during the housing bust, saddling some investors with heavy losses from instruments they didn't understand. If investors have any concerns about a replay in the CLO market, they're hiding it fairly well. Money has poured in. Still, there are plenty of people who think that CLOs and the leveraged loans that they buy are a potential trouble spot that bears watching. For one thing, those loans are increasingly made without the kinds of protections that restrict activities like paying out dividends to owners, or taking out additional borrowing, without a lender's approval. Roughly 80% of the leveraged loan market lacks such protections, up from less than 10% more than a decade ago. That means lenders, for now, such defaults remain quite low. But there are in recent weeks, warnings about the market for CLOs and leveraged loans have been multiplying. Last month, small, subjective loans. Leveraged loans are risky, but some companies are seen as even too rickety, or too small, to borrow in that market. Not to worry. There's a place for them. They've been around since the 1980s, after Congress changed the laws to encourage lending to small and mid-size companies that couldn't get funding from banks. But BDCs aren't charities. They're essentially and they appeal to investors because of the high interest rates they charge. Their borrowers are companies like Pelican Products, a maker of cell phone and protective cases in California, which paid an interest rate of 10.23% to its BDC lender, a rate that reflects its high risk and low credit ratings. For investors, an added appeal is that the BDCs don't have to pay corporate taxes as long as they pay 90% of their income to shareholders. So, naturally, BDC assets have grown fast, jumping from roughly $10 billion in 2005 to more than $100 billion last year, according to data from Wells Fargo Securities and Refinitiv, a financial data provider. Some analysts argue that risks embedded in BDCs also can be hard to understand. Because BDCs have also been increasing leverage to bolster returns. It means they're using